Welcome everyone to Hidden Wealth, tapping into the power of SDIRA and Solo 401k. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with Checkbook-controlled. Our presenter today is Brett Sininsky, and I briefly want to introduce Brett to you. He is a Solo 401k and SDRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brad is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. So, thank you again, Brad, for joining us today, and I'll let you take it from here.
Yes, thank you so much. I am still sharing my screen, so I assume you can still see it and you can hear me okay, right?
It's perfect.
All right, awesome. Thank you so much. Okay, so yes, we are here to talk about hidden wealth, tapping into the power of the self-directed IRA and solo 401k. In a little while, we've already mentioned this, but if you're just joining us, I will have a special guest come on. I'm looking really forward to hearing from this person. We've been promoting his visit to us today, and so hopefully you saw some of that, and maybe that's why you're here. You want to hear from this person. He's got a great story, and I can't wait to share or to hear from him, share about how he's using his solo 401k to invest. My name is Brett Sininsky. I am a solo 401k consultant here at Sense Financial, also a self-directed IRA. Housekeeping wise, we are not a fiduciary. We don't provide legal, tax advice, investment, or accounting advice. If you need such professional advice, please seek out that proper expert. Why us? Well, real quick, we have clients all over the place. We service all 50 states. Our clients stay with us for a long time. Most of our business comes from referrals, and most of those referrals come from existing clients. We also have a lot of professional relationships with tax advisors and syndication operators and all sorts of different people. But by and large, the largest quantity of referrals comes from our clients, and we appreciate that more than we probably can explain. But referrals are the lifeblood of our business. I think it also is a testament to the level of service we provide and the satisfaction, although that's not our aim. Our aim is to wow with service, and we do that. And I think that it shows with the 5-star reviews we have all over the place. So Google Sense Financial and reviews, and you'll see. Check it out yourself. All that to say, this is why you should listen to us today. And also, if you're considering self-directing your retirement in the form of an IRA or 401k, do your due diligence, before you invest that, not the money, but before you create that plan or have that plan created by a company. Just check them out. We've been around since 2010, almost 15 years, way past the startup phase. And the founder, Dmitry Fomachenko, has really set his eyes on self-directed IRA and solo 401k only pretty much since the beginning. And so we are hyper focused on those two products and those two products alone. And we do them at a very high level because of that. As often as I want Dimitri to say yes to some of the shiny object offers out there to add on to our business, he's been very diligent about not doing that, probably wise indeed. Our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. And you work hard for your money. We want to come alongside you and work hard for you as well in this capacity. And we'll talk about this mission is kind of what we're going to talk about the whole time. And we'll hear from our guest about this as well and how he uses it. And let me get into it. There's two different types of accounts, okay? There's conventional and self-directed. And by the way, I'm going to move a little bit quicker than you may have heard me on other calls because I want to give our special guest ample time to share what he's got to share. So bear with me. If something's not clear or you have a question, like I said, put it in the Q&A and we'll get to it at the end. The conventional side of investing, think about Fidelity, Schwab, your financial planner, conventional financial planners, if you will. Primarily, your money's invested in Wall Street, stocks, bonds, mutual funds, and ETFs. In fact, if you go through a broker dealer for your IRA or 401k, like Fidelity or even your employer-sponsored plan, it's in Wall Street. There are some employer-sponsored plans that are kind of creative, but that's by and large not that is the exception, not the rule. And so that's your train, that's your bus that it takes you from point A to point B, but it's very restrictive. On the other side, you have the off-road vehicle. This is the self-directed side. It can go where the bus can go. I wouldn't drive on train tracks necessarily, over maybe, but not on. And but it can also go other places, right? It can go on the highways, the byways, the streets, off-road, through water, over rocks, etc. So that's the self-directed side. It very much is like the Wild Wild West, which makes it exciting, but also a little bit dangerous if you don't know the rules, and they're not complicated. We'll talk through some of those briefly here today. But what it does is it allows you to truly diversify. If you're in the stock market only, are you diversified? Maybe. Maybe you're in like energy sector and foreign investments and, S&P 500. Okay, fine. But it's all Wall Street. And how much control do you have over those investments? You have zero control. Unless you're Elon Musk and you're running Tesla, you don't have any control over Tesla. Okay. So you can't control the performance of the stock. You can't control the returns that are from it, et cetera. Now, with a self-directed account, you have way more control. I can't use the guarantee word because there are no guarantees, but think about it like this. If two parties are signing on the dotted line, whether it's a tenant and your IRA or a private loan to a borrower, fix and flipper, owner occupied, investor, business, whatever it is, there's two people signing on the dotted line. There's terms that are clearly laid out. There's an interest rate. There's points, no points, whatever. And then there's a payment structure, right? Monthly, quarterly, annually, balloon, no balloon, whatever it looks like. Like two people are agreeing to that. Okay. Could they stop paying? Sure. Anything could happen. If it's secured by real estate, great. You foreclose on the property and now you own a property that you didn't necessarily intend to loan. You could sell it or rent it out or whatever. It's secured by real estate, a hard asset, which is great. But most of the time, people aren't just going around defaulting on their payments, right? It can happen. But again, there's safeguards in place. So I digress. I just want to paint a picture of the difference between the control that you can have and the predictable outcome from your investments when you self-direct, especially when it comes to real estate in some way, shape, or form. But it's not restricted to real estate. You can do cryptocurrency, precious metals, private lending, not just real estate, businesses, private equity, tax deeds, trust deeds, commercial real estate, residential. There is no way to exhaust the list. The IRS only tells you what you can't invest in, cannot. And I will explain that here in a moment. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And yeah, I mean, we had 2008. That was a while back, but for a lot of people, it wasn't that long ago. We had the COVID thing that, maybe there was a little downturn, but then things went bonkers again. But if you were truly diversified, especially in 2008, if you were in the stock market only, as I actually was at the time, I had rental properties at the time, but my retirement accounts were not in real estate. They were in the stock market. I saw a big dip. I didn't really care that much because I'm not close to 59 and a half in 2008. I'm a little closer now, but not quite there yet. And so I didn't really care. I was still buying it. And so I was buying it on sale at that point. And then it eventually went up again, of course. But if you were about to retire, like that was bad, man. That was detrimental to a lot of people. If you were invested in some of these hard assets or private loans and maybe some stock market as well, like you were pretty much kind of covered from the big dips. If you had the investment property, yeah, the value went down, but you're still getting the rent payments. So if you were about to liquidate it, guess what? You were going to hold it a little bit longer, but it went way back up and way beyond. So I digress on that, but that's how you get true diversification, is by actually taking control of your retirement through a couple different products. We specialize in these two, self-directed IRA and solo 401k. IRA, anybody can do. Okay. We can, even minors can do IRAs. We don't do a lot of those. It's not super common, but they can. Whereas the solo 401k actually has a self-employment requirement attached to it. So it's primarily for the business owner and their spouse. But it actually works, and I'll diagram it out here in a moment. It actually works for any business type: S Corp, C Corp, single member LLC, partnership, sole proprietor. If it's a partnership, all the partners can actually participate in the same plan. You just can't have any full-time W-2 employees outside of the owners, the partners, and or spouses. And so that's how it works. If you have full-time employees in any business, you probably don't qualify for an individual 401k plan. It's called a solo 401k for a reason. So here's how the checkbook IRA works. First off, there's two different types of self-directed IRAs. There's a self-directed IRA where you have to go through the custodian for all transactions, which causes red tape, transaction fees, and time that you may not want to take. We only do the checkbook control, aka checkbook IRA, which allows you to bypass the process I was just talking about. The custodian's still there. They're still there for distributions. They're still there for Roth conversions, for contributions. I said that for transfers from existing retirement accounts. So they still play a role, and it's required by law that an IRA has a custodian, but we bypass them actually with the use of a special purpose LLC that I'll explain here in a moment. And so first we open a new account with a IRS approved custodian. This is not your Fidelity or T. Rowe Price or Schwab type of account or Vanguard. This is a custodian that allows for any investment allowed by law. Okay. So just because Fidelity says you can't invest your IRA into real estate doesn't mean you can't. It just means that they don't offer it. Okay. And they're the custodian, so they control what is allowed. So this custodian allows for anything allowed by law, which I'll tell you about the exceptions here in a few minutes. So once the custodial account is opened, a qualified transfer is set up. This is from an existing retirement account. Now, you don't have to transfer money in. Most people do, because starting from zero in the IRA with a $7,000 annual contribution limit is hard to invest in alternative assets unless you have, 30, 40, 50, at least $1,000. And there are some opportunities lower than that, some crowdfunding options as low as $500, but typically people are rolling in existing plans. Okay. 401k, 403b typically needs to be a former employer, but not always. Happy to talk through that if you'd like, but typically it's former, existing IRA. This can be Roth or traditional. Okay. Then we set up the special purpose LLC. Now, the operating agreement of this LLC has very special language, which designates you as the manager, but not a member. The only member is the IRA. And there's language in there that spells out exactly what you can do and not do, because you are a disqualified party to the plan. That's why it's special purpose. This is not the LLC that you're running your business through or holding your real estate in personally, right? This is for the use of what we're talking about here. So as the manager of the LLC, you have that checkbook control, which means you can make decisions. You can sign on the dotted line. You can write checks. You can do online bill pay, wire transfer, all of the above. All the assets are in the LLC, including the bank account. So you have the custodial account. Transfer goes into the custodial account. Once the LLC and the bank account is set up, then the money transfers from the custodian account into the LLC checking account. That's when you're ready to self-direct. Takes about 3 to 4 weeks altogether, sometimes a little bit longer, depending on how quickly the qualified transfer occurs. Different custodians take different amounts of time, but plan on 1 to 2 weeks for that. Typically in 4 to 5 weeks, it's all set up completely. And then once that's done, you'll be able to invest. All the income and expenses go out of and go back into that checking account. That is the home for the money. Okay. It's still in the IRA LLC as well as the investments. It's just a checking account, right? So that's where you make your bill payments from. That's where the money goes in, the rent checks, whatever. So that's how the checkbook IRA works. Now, the solo 401k is a little different and similar in a lot of ways. First off, you have to have that plan sponsor, that self-employment. And listen here, if you're not self-employed, it's not hard to become self-employed. Okay. You can mow lawns on the weekends or sell stuff on eBay or get your real estate license and sell one house every other year. It's about the activity, not the income. All right. I could be self-employed tomorrow. I am self-employed, by the way, but if I wasn't, I could become self-employed tomorrow. I could do it today if I wanted to. It's about the activity, right? Hey, guess what? I'm going to join a network marketing company. selling, I don't know, skincare products. Okay. If I sell something, I get a 1099. It's not about getting the 1099. It's about the activity that is working towards getting the 1099 income. I'm self-employed. I could be self-employed today. That qualifies you for solo 401k, irrelevant of whether you have a W-2 job currently or not. Okay. But I digress. Let's go through this diagram. So you have a sole proprietor, corporation, S Corp, C Corp, single member LLC, partnership. They all work. Okay. It just depends on your specific situation. Again, you can't have full-time W-2 employees outside of yourself and a spouse, or if it's a partnership, non-owners. Okay. So once we establish you qualify, then you're ready to go. The solo 401k plan is created. It's an adoption agreement and it is a trust. Okay. And because it's a trust, that's where all the assets are held. So in the IRA, they're all held inside the LLC. In the solo 401k, all the assets are in the trust. You're the manager of the LLC. With the 401k, you're the trustee of the trust. Okay. So there's no custodian. You can be the plan administrator. You can do your own Roth conversions, your own contributions, your own distributions, your own investments, etc. So the solo 401k is a little more flexible. It is easier to maintain too because you don't have the custodian, and we provide all the documentation you need to do everything that we've talked about. And then you open the checking account similar to the IRA LLC. This checking account is the home for the funds until they're deployed into an investment. You can also open a brokerage account at Vanguard or Fidelity in the name of the solo 401k if you want to simultaneously have money in the market as well. That is also an option. And then all the money goes into and out of that checking account, just like the IRA. So we're going to talk a little more about the solo 401k, and then I'm going to introduce our special guest here, probably in about 5 or 10 minutes. So the 401k has much higher contribution limits. Okay. Over $77,000 a year if you're over 50. If you're under 50, it's 70,000. The next slide will break it down. I'm not going to go through it all just due to time restraints, but you can take a screenshot of it if you'd like or whatever. But there's two buckets. Okay. You have as being self-employed, the IRS says, hey, you're not only an employer, but you're also an employee. And so they let you make contributions to as both of those types of people or entities. The wise man saves for the future, but the foolish man spends whatever he gets. Proverbs 21:20. So what we're talking about here is saving for your future, right? And a very creative way to do it, potentially, depending on what you invest in. So the way it works is as the employee, this is the same contribution limit that you have at a W-2 job. If you're under 50, it's $23,500 for 2025. If you're over 50, you have that plus a 7,500 catch up for 31,000. This can be up to 100% of your self-employment earnings. Okay. So if you make 23.5-ish, then you can put in pretty much the whole thing. If you're running payroll, you have to account for FICA and Medicare. So you're probably going to run a payroll if you're S Corp or C Corp of about 25 so that you can get to the 23,500. All right. These can be either pre-tax or Roth or a combination of the two. Inside the 401k, you have both of those types of funds, Roth and pre-tax. An IRA is either Roth or pre-tax. You can have both, but they're not combined in the same plan, unlike the 401k. In addition to that, you have the profit sharing, which is roughly 20 or 25% of the profit, or the W-2 if you're C Corp or S Corp for the year, on top of the 23.5. That's how you get to the 70 or the 77,500. Okay. So that's how the contribution works. Now you can't double dip on the employee contribution. If you're maxing out your W-2, you can't also put an employee contribution into your solo 401k. That max is per person, not per plan per year. Okay. Now you can go from 0 all the way up to 70,000 with just the profit sharing. This is a business expense. Of course, your business is going to be making 300 or so K for you to be able to get to the 70,000 at 20 or 25%. But you can do it. Okay. So just something to bear in mind. If you don't have a W-2 job or you're not maxing it out, of course, you can max out the 23.5 plus the 7,500 catch up if you're over 50 in the plan to get to the 70 or $77,000 faster, okay? Because it's not all just a percentage of the income or of the profit. You can use a loan. You just can't provide a personal guarantee. So if you're thinking about buying real estate using your IRA or 401k, the property has to be the only security. You and your immediate family are disqualified parties to the plan, so you can't provide that personal guarantee. You can't be a guarantor. Your credit, your income is not a factor. It's just the property, and therefore it requires more down. It's a higher risk loan, and only certain lenders will do it. We have a list of 8 or 10 on our website there. You can see the URL at the bottom, SenseFinancial.com /non-recourse lenders. It requires 30 to 50% down. It needs to cash flow, not a lot, a couple $100 a month or so. Typically, they require about 6 months of reserves. You might find one that's doing 3 months, but I've seen 6 more often. This will trigger a UDFI, unrelated debt finance income tax, in the IRA. We can dig into that. I'm not going to unless somebody asks the question. The solo 401k is exempt from that tax. So if you're going to buy real estate and get a loan, it's better to do it in the solo 401k, so you don't have to worry about that. And then just check out the lenders. They all have different pricing and terms and such. So that is that. Now, I am going to introduce our guest, and hopefully he can pop back on the camera. I don't know. He can tell me just audibly. That's fine. There he is. Let me introduce him, and then I'll ask him a question. First off, Edwin, his name is Edwin Epperson. Okay, so Edwin has been investing in private loans secured to investment properties since 2014, when he made his first loan on the side of a mountain while deployed to Afghanistan. Edwin served in the U.S. Army and was honorably discharged after 13 and a half years of service with 7 combat deployments. And he earned the Green Beret and operated with ODA 7325. I don't know what that means, but interesting. As a combat diver. Edwin currently manages a customizable private debt and equity fund investing in real estate across the Southeast United States. He has deployed over 30 million of his and his investor capital into 150 plus investments with a historical annual average return of 9.33%. He also manages an exclusive boutique crypto trading fund with personally known select investors. He is an active church member, married to Carolina Epperson, and the father of 2 boys, 18 and 14. Edwin, welcome.
Thank you. Thank you very much, Brett.
Absolutely. Hey, do you have a presentation that you'd like to share? If not, that's okay.
So I didn't have a presentation specifically for today. I figured it was just sort of shoot by the hip.
Yep, that's fine. So on the screen, guys, there's a QR code. You can scan that to get his personal information, or at least contact information if you want to reach out. He's more than welcome to hop on a call, as I'm sure he'll explain. But otherwise, Edwin, I'm going to let you take it from here, my friend.
Appreciate that, Brett. And hello, everyone who's joining the call. Thank you, Brett, for having me. And a special thanks to Dimitri. I've known him for many, many years. I set up my solo 401k back in 2016, July. And it has been, so I probably, like many of the attendees, whether you all are looking to make a decision, whether you go the IRA route or the solo 401k route. For me, after sitting through a presentation much like this, I just realized that it would be financially lucrative to go the solo 401k route. And like Brett said, it's not that hard to be self-employed. Brett, correct me if I'm wrong, but my understanding and the way that I've been operating my solo 401k is the entity that holds that trust plan for the solo 401k. The only way that contributions can be made to that solo 401k is if the entity is actually producing an income, correct?
You mean the sponsoring business, right?
It's a sponsoring business, sorry.
Yeah. Well, it's about the activity, actually, not the business, believe it or not. So, I mean, ideally,
you're going to enlighten me, because I was sitting here and as you were presenting, I was like, I'm going to ask this question, because if you guys can't, I'm not Dimitri, I'm not Brett. I don't know all the ins and outs, and I'm constantly learning, which, by the way, For those of you who are here and you're just trying to figure out, hey, who do I want to be my custodian if it's an IRA, or who do I want to be my plan sponsor? I will tell you, Sense Financial has probably one of the most robust training and educational content that you will find out there. They are really, really solid, and there's so much content that they have constantly been putting out. So you can get lost in the weeds, and I manage several different things, as Brett mentioned. So I'm not an expert at the solo 401k.
Let me let me ask a couple of questions, and I'm going to let you kind of do your thing, but I want to just kind of let people know like your relationship with Sense Financial and all that good stuff, if that's okay.
Sure.
First off, do you remember originally how you heard about us?
I honestly do not. I know that it was back in 2016. This was 2 years after I started my private lending activities. And I realized that I wanted to have a portion of my activities coming from a tax advantaged account, specifically earmarked for retirement. And so I'm sure it was at some type of conference, some real estate investment focused conference. And Sense Financial came up with several others. There's quite a few IRA custodians in the space. There's honestly not that many solo 401k plan sponsors in the space, but I heard about Sense Financial. Probably, I'm going to say, either through my own research or just going to a conference and hearing Dimitri and Sense Financial.
So Dimitri is an electrical engineer by trade. Because Dimitri is an engineer by trade, he's very meticulous about stuff, which is good. It's great for clients and for running a business. That said, we have good records of who sends people to us and where they come from. So allow me to share.
You can tell me. Yes, please.
I can. Our records indicate that you found us on Bigger Pockets, which is a Facebook forum for real estate investors, for lack of a better term. And we're not here to talk about Bigger Pockets, but if you haven't been on biggerpockets.com to learn about creative ways to invest your money, and especially in real estate, I would highly recommend you check it out. So anyway,
go.
Cool. And then you said you've been a client of Sense Financial Solo 401k since July of 2016. Thank you for that. Actually, I found the July part. You said 2016. And then, I think you're going to share this, but I'm just going to let you talk. I'm done with questions.
Okay.
Go for it.
All right. For anybody else that has questions, please feel free to drop them in the chat. I'm sure Brett will be monitoring. I'm switching over there right now, so I'll monitor those as well. As I said, the solo 401k was really attractive to me because of the amount that you can contribute, and it's interesting. I would like to probably I'll have to go on in some of your training videos. Maybe you can provide a link to everyone of the separation or the bifurcation between business activity versus business revenue, and being able to contribute from the business to the solo 401k as well as an employee. I've been if it's a more broad spectrum, then I can, I've been missing out. One of the things that I really focused on, because I am on the private lending side, over the years I've advanced and invested. I now manage a 506c, which is a non-registered securities offering with the SEC. We are registered with the SEC, so we can raise capital from accredited investors, and we put the capital to work primarily in real estate loans to real estate investors. So short-term lending. And one of the things that I've seen talking with investors is, and you mentioned a different acronym, a UDFI. I've heard of UBIT, UBIT, and I'm not sure if there's, I've not heard of the UDFI, but I do know that anytime besides the 401k, but especially a self-directed IRA, if you're going to go out and use your self-directed IRA to purchase real estate, which is what a lot of people are interested in doing, you will incur that UBIT tax. And I don't know if UDFI is an additional tax or if it's a newer acronym that replaces UBIT. But that is something that investors have to be aware of. They have to be, that has to be consideration. And the reason I gravitated more towards private lending is because you control the asset without actually owning the asset, and therefore without actually having to qualify or be penalized for going out and getting a loan. So you get the benefits of real estate without the hassles and headaches of real estate. And so that's really what I use my solo 401k for. We do invest. I invest a little bit into a crypto trading fund that I manage on the side. I love the idea of investing in crypto. You've got, investing in stocks and in the stock market. But I think that, as the world continues to progress, whether we appreciate that or whether we don't, at the end of the day, crypto is not going anywhere. It is here to stay. And there are a lot of utilization cases for crypto that is being made in the space, both in real estate and business transactions all across the board. And I believe that for those of you who are not at least becoming educated on crypto, you will be missing out on a lot of future opportunities. And ultimately, I do see that that's where the world is going, whether we have a central bank currency, which would sort of violate the rules of why cryptocurrencies were created, with the non-decentralized process. At least that's what a lot of the white papers, and especially Bitcoin's white paper, was focused on, is the decentralized aspect of money, if you will, of these crypto coins. But I would highly encourage, if any of you are considering investing in crypto, definitely do your research. There is a lot of ways to do that, a lot of different strategies. A lot of them are can be very similar to the stock market. So if anybody is familiar with looking at technical trading, options, puts, almost every single type of methodology to invest in the stock market, you can apply that to the crypto markets. And there are great platforms. We use a Kraken platform for our fund. And so it's a brand new world. There's a lot of education out there. It's really unique, and it's really volatile. It is very, very volatile. So, being wise with how much you allocate, like Ecclesiastes says, divide your portion between 7 or 8. Crypto probably be that or 8 portion, and it might want to be a smaller portion of your retirement. But there's a lot of fun in there with the volatility. It offers a lot of opportunity to create wealth rather quickly. Going back to what my day-to-day business is managing private loans made to real estate investors, and doing so within a solo 401k or self-directed IRA. It's just got a lot of benefits. You control the asset without actually owning the asset. And while a lot of people like to have their name on the title, there's a lot of benefits to controlling that asset. Number one, if you're making a loan, you're investing in a loan to secure the real estate. It's typically at a deep discount from what the real estate's actual value is. So, one of our policies is the maximum loan to value that we ever do would be 70%. So there's an automatic 30% equity cushion in that property. If the borrower does not adhere to our mortgage, the loan agreement, which is a very, very detailed process of explaining to the borrower, this is what our expectations are, this is what you're required to do. They don't meet that, then the loan goes into default. They have to cure that default within a period of time, which is laid out in either the mortgage or the deed of trust, state dependent. And then if they don't cure that, the loan goes into default. You hire an attorney, you go through the process. Some states are a lot quicker. I live in the state of Florida. It's a lot longer. An uncontested foreclosure will last you about 9 months. A contested foreclosure where the borrower hires an attorney and there's this back and forth could be up to 2 years. But ultimately, you have that control of the asset. And because this is a legally binding document that is recognized by the courts throughout the entire United States, you as a lender will get that asset. Now, the key to be aware of is in the process of you deciding to make that loan using your solo 401k or your IRA, did you do the proper underwriting and due diligence to make sure that you're identifying the risk, mitigating those risks, and then shifting those risks to someone else, i.e. the borrower? If you did a good job of that, then you've got a lot of equity that, in the case of a foreclosure, worst case scenario, in the case of a foreclosure, you're going to get that asset back, and you've got all the equity that is now your solo 401k or your IRAs. And by the way, if you're making the loan inside your IRA and you take that asset back, you're not incurring any UBIT or UDFI because you were the bank. You were acting in the capacity of the bank and you made the loan. So there is, at the moment that you take that asset, there is no existing other liens, especially if you let it go through foreclosure. All other liens are wiped out. The first position lien, which hopefully is you get that asset free and clear, basically. So now you have a free and clear asset in your trust for the solo 401k or for your self-directed IRA. So there's a lot of benefits, and I strongly encourage. You mentioned diversification, Brett. The diversification is not just diversifying outside the stock market and then investing only in one sub-asset class. I'm a big believer in education. If you go to our website, bluebayfund.com, there's a journal that I have there. It's called the Cigars, Whiskey, and Capital. Those are the three things that I really enjoy. So we've got a Cigars, Whiskey, and Capital journal. And on that journal, we write a lot. I write a lot about different investing strategies, different approaches to investing, specifically around private lending. But within there, I'm a big fan of real estate or investors understanding what is the biggest risk in investing, and that is, what side of the capital stack are you investing in? Are you investing in debt or are you investing in equity? There's really only those two sides of any investment. Then underneath each one of those main categories, you have your markets. So you can be invested in paper market and the crypto market. You can be invested in hard tangible markets, or you can be invested in business markets. Crypto, paper, insurance, stocks, bonds, cryptocurrencies, my goodness, what NFTs. So all of those are on the paper side. And then in the hard tangible market, like many of you who are here on the call, which are probably very interested in diversifying outside of the paper markets into the hard and tangible markets, those would include gold, silver bullion. Those would include, planes, trains, and automobiles. Those would include real estate, of course. And then the third market is your business market. So for those of you who have quite a substantial amount in your solo 401k or IRA, then you can direct those vehicles to invest in businesses, such as taking the role or the capacity of a venture capital, private equity. There's a lot of strategies as far as investing in businesses. Brett, I'm not sure. I've not heard of anybody doing this, but I'm pretty sure it's possible because it's not one of the categories that the IRS restricts you from investing in with your retirement account. But you could even invest as a franchisee. Now, there might be some restrictions if you're investing in a franchisee using a self-directed IRA, because most franchisees or franchises require the franchisee owner to actually be involved in the business, and that could violate some of those arm's length transactions, especially in the self-directed IRA space. So everyone, you would have to be aware of that if you're considering investing in the business market. But the business market is one of those markets that you can then direct. And then underneath each one of those markets, you have your asset categories. Inside each asset category, you have your sub-asset classes. And most people call asset classes like that's your asset class. Well, it's actually a sub-asset class to your asset category. And then you have your strategy. So those are the 5 pillars of investing. And really investors need to be aware of all 5 of those pillars and understanding the risks that are inherent to each one of those. Your primary pillar, which is debt or equity, then your secondary pillar, which is your markets. You have 3. Then underneath that, your third pillar, which would be your primary asset classes or your asset categories. Then you have your sub assets, which is a pillar 4, and then you have your strategy, which is pillar 5. So I go on that because I'm very big about the educational component. And so on my Cigars, Whiskey, and Capital blog, that's where we provide a lot of educational content for the private lending space, but as well as just general education for investors so that they can invest with wisdom. They can make wise and informed decisions for their retirement accounts. And I can talk for as long as you want about whatever, but I like some interaction. So if anybody's got questions, very happy to answer questions. Brett, if you've got some, or we can just go back and forth.
Sure. Yeah, no, I do have a few actually. And please, audience, if you do as well, definitely put them in the chat. We're happy to answer questions. I'm curious on the crypto side of things. Now, let me back up a little bit. Most of our clients are looking for something in real estate, typically, right? It could be private lending. It could be actually owning the real estate inside the plan. some people do some light fix and flipping. You have to be careful with how much you do because it could trigger unrelated business income tax if the IRS says you're running an active business. And flipping is definitely an active business, but you can get away with a couple each year. And so probably what most people don't know about is the crypto. And at least from our clientele perspective, and we do have clients doing it. Now, understand something, everybody. The reason I wanted to talk to Edwin is not just because of he's a great dude and he's got a ton of cool experience, but also we're not always privy to what our clients are investing in unless they tell us, because they have checkbook control, right? So they don't have to go through us for anything. People ask that a lot, like, what are your clients investing in? Well, I know what they've told me in the initial consultation, but I'm not really sure what they're investing in unless they've come back around and said, hey, I'm buying a rental property, or I asked.
Right.
So that's part of the reason we wanted to hear from one of our clients. But regarding crypto, have you invested actually? Does your 401k own crypto or no?
So that's where the dynamic with investing in crypto is so shaky, right? So number one, you have to have a bank that understands that the bank account will not hold crypto. So there's two ways to hold crypto. You can either do a cold wallet or a hot wallet. A hot wallet would be something like on an exchange. So let's say you open up an account on Coinbase, Kraken, Gemini, Binance.us. I mean, there's a like literally thousands of different crypto exchanges. So you open up an account on the crypto exchange, and you have to open it up in the account of whatever the money is coming from. And so in this case, if you're using a solo 401k, it would be your trust bank account. If you're using a self-directed IRA, it would be from your self-directed IRA's checkbook account. So then you have to open up the account on the exchange with your account. And then on the exchange, once you move money from your account, which is very easy, it's a simple wire. You move the money in. You now have, your exchange account in your self-directed IRA or solo 401k can then trade in that account, and all the crypto that you purchase and then turn around and sell, if you're doing that, or if you're just holding it, it stays on the exchange. That's called a hot wallet. Now, if you move that crypto out of the exchange onto a cold wallet, which is typically a USB or some format like that, to where you are taking it completely off, it's not connected to the internet at all. That's called a cold storage. And honestly, for those who are literally investing in crypto just to hold it for the appreciation, for the long-term gain, that is the preferred way to do that. I don't hold anything in a cold wallet. I'm not sure because you have to remember, if you purchase it on the exchange and then you transfer those cryptos into a cold wallet that you now personally have, number one, you personally are in, it's like honestly in your hands, right? So I don't know what violations, if any, arm's length transactions would occur if you're using specifically like self-directed IRA. So we don't do cold wallet, we do hot wallet. So we simply move the money in. I move, allocate a portion of my solo 401k investment, and then every month or every quarter we'll move money in, and then I do day trading or some long-term, it's typically for a couple of months, but the goal is to buy and then sell on the crypto exchange.
Got it. Okay. Very cool. Yeah. You can do cold storage with your IRA 401k. So you can actually possess that USB or flash drive, whatever you want to call it. And then you can also, of course, open up the exchange account with the name of the 401k or IRA and its EIN number, not yours. And then Gemini typically works the easiest with IRAs and 401ks, but there's no restriction to using Kraken or any other one for that matter. So, but I would plan on, if you're going to do crypto, and I don't want to turn this into a giant crypto conversation. In fact, we need to wrap this up in just a few minutes. If you're going to do crypto, first of all, like Edwin said, do your due diligence. Actually, let me speak to that briefly. You're the fiduciary of your retirement plan. It is your job to grow it aggressively, yes, but also safely and smartly. And so you don't want to don't invest in something you don't understand. And if you're going to do crypto for the first time, it should not be your life savings. It should be a very small portion of money that you don't care if you lose. Okay. And I'm saying that, I'm really actually kind of saying that about any investment, although crypto is, in my opinion, and I think a lot of other people, is more speculative than real estate or doing a private loan. So there's certainly, if you don't know what you're doing, some more risk than those investments. But we're not here to provide investment advice or tell you what to invest in. Do your own due diligence. Talk to your tax advisor, financial planner, CPA, whatever. I'll give you my 2 cents, but it's not advice. Take that for what it's worth. And so, yeah, I think that's awesome, man. I appreciate you sharing. I have a couple more slides I want to share before we wrap up. If anybody has any questions, it's not too late. Please throw them in the chat. You guys are quiet today. Happy to ask them, or answer them rather. Before we kind of move on, Edwin, actually, you know what? I'll pull that back up. Let me share that. I assume that has your website on it as far as the QR code goes. And
yeah. So the QR code is it's a dot. I think it's like called card period card. And so it's like a Linktree or any of these other QR codes. But in that QR code, you'll have my contact information. You'll have our website, so you can sort of look me up and do some, just due diligence on your own to see if I would be anybody that you would like to discuss at least some strategies. But yeah, my contact information is there. Please scan that and access that. And then, yeah.
Excellent. Anything else to add, Edwin?
No, you did mention what is an ODA. So ODA stands for Operational Detachment Alpha. And so it's I was on an A team. If you remember the 1980 show, I was on an A team as a Green Beret combat diver. So yeah, I was with 7th Special Forces Group out of Eglin Air Force Base.
Very cool. Okay. Well, yes. And I should have led with that, man. Thank you so much for your sacrifice for this country. We appreciate it.
That's okay. Thank you.
Yeah. No, absolutely, man. It's yeah. I mean, obviously I didn't serve, or I probably would have known what that acronym meant, but anyway, we appreciate you. So absolutely. Well, thanks so much for coming on. I have a few more slides. Edwin, please stick around in case anyone has a question. We'll wrap this up in about 10 minutes, everybody. But let's see here. Come on. There we go. Okay. So this slide is a chart of this helps me to remember everything I forgot to talk about during the initial presentation, but the self-directed IRA versus the IRA LLC versus the solo 401k. Now, we already talked about this. The self-directed IRA is that full custodial IRA where you have to go through the custodian for all transactions. They're on title for benefit of your retirement account, and there's red tape, transaction fees. IRA LLC bypasses that. Solo 401k bypasses that. The LLC, when it comes to that, you're responsible. So our establishment fees include everything for the first year, the filing of the LLC, the establishment of the plan, everything. We offer unlimited client support beyond that and during the establishment. But after year number 1, you're responsible for taking care of whatever the state that the LLC is filed in requires. In California, it's $800 a year. Drives me crazy. Other states like Arizona is $0. I'm not sure what Florida is, but it's less than California. I know that for sure. And so just bear that in mind. Solo 401k does not require the LLC. Some people do it for limited liability protection, but you don't need it. Most of our clients just hold the assets in the trust as is. I don't think I talked about the personal loan. The Solo 401k has a participant loan option, which is up to 50%, not to exceed $50,000 of the plan, whichever is less. And so that's something that the IRA does not have. You can use that for virtually any reason, including investing with someone who would otherwise be a disqualified party. We didn't talk about this, but you and your immediate family, your parents, your grandparents, your spouse, okay, your spouse is not a lineal descent, but Bible says you and your spouse become one, right? One flesh. IRS says the same thing in regards to how they treat you. And so you and your spouse are disqualified parties, your children, their spouses, and then of course your parents and your grandparents. So brother, uncle, aunt, friend, step parents, etc., are not disqualified parties. What does that mean? Real quick, none of those people, including you, can personally benefit from anything that the 401k or IRA owns. And also, you can't perform any services. So the way that think about services is you can do the white collar work, but not the blue collar work. Okay. You can, you could vet potential tenants and even sign on the dotted line with the rental agreement, but you could not go and take photos of the property. You could not go sweep the property even. I know it sounds trite, and it probably is, but that's where the IRS draws the line. You can't do this physical work, so to speak. You can walk through the property if it's being rehabbed and make sure that the tile was put in correctly. That's okay. You can hire the contractor. Contractor can't be any of those disqualified parties. Okay, so I'm done with that, but just understand the disqualified parties, prohibited transactions. Essentially, if everything is third party, you really don't have to worry about a whole lot. Super catch-up is available if you turn 60, 61, 62, or 63 in any given year. In the 401k, it allows you an additional catch-up contribution of a total of $11,250 instead of just the $7,500 if you're over 50. So real quick, $70,000 under 50 annual contribution, $77,500 if you're over 50 annual contribution, and then that $81,250, I think, if my math is correct, for the super catch-up if you're between 60 and 63. And then the built-in Roth, this is another reason why the 401k is so awesome, is that it has Roth and pre-tax built into it. I mentioned this earlier, but the IRA is either a Roth or a traditional IRA. You can't combine the two. Now, you could invest together. That's a deeper conversation, but you can invest the funds together. You can do the same thing in the 401k, but in the 401k, the name of your 401k, Joe Smith 401k plan, is the owner of everything. And so you choose which assets are making that investment. It could be Roth, it could be traditional, it can be employee contribution, it can be profit sharing contribution, it can be rollover funds. They're all in the same plan. Okay. And of course, lastly, the IRA requires no self-employment where the 401k does. If you want to talk to me, jump on my calendar, SenseFinancial.com/consultation. Otherwise, if there's any questions, I'm happy to take them. I'm going to put Edwin's information back on the screen real quick in case you guys want to grab that. But it looks like there's no questions. Man, you guys are quiet out there, but that's okay. We appreciate everyone attending, and I am going to wrap it up in about 45 seconds if you guys don't have any last minute questions here. Thank you so much for attending. If you'd like to jump on Edwin's calendar, get a hold of him there. If you want to jump on mine, SenseFinancial.com/consultation. No hard selling. This is just a discovery call to find out more about you and your goals and answer your questions. If you don't become a client, that's fine. If you do, great. No pressure. You're going to walk away from the call with information you did not have before that you can use for the rest of your life and share with your friends at a cocktail party. I promise you. And we're barely scratching the surface here. But yeah, let's wrap it up. Edwin, thank you so much. Everybody else, thank you so much for being here. And we'll talk to you guys down the road. Have a good one.